Also, let's take a quick look at what our wise experts have to say as we head into trade this Monday morning. Neelkanth Mishra of Credit Suisse says the shortage of money is a drag on growth and creates deflationary pressures. Weak economic momentum became visible through discretionary demand, but recent commentary points to this extending to staples as well. Even if there are no mishaps in the NBFC space and their access to supply of funds from mutual fund continues, it is unlikely that they will be able to accelerate credit growth in the next few quarters. Unless there is significant monetary easing, growth could remain weak for a while. Credit Suisse stays underweight on consumption, while low utilization keeps them overweight on investment. That's been a call that he's taken for a while, that growth will be slow, especially on the NBFC front.
NBFC, no, at the moment he's extending it to consumption staples.
Yeah.
First it was consumption durables and now it's staples. Okay, there's more equity opinion. Mahesh Nandurkar of CLSA says the rupee has gained 7% from its all-time lows made in October 2018 as current account deficit stabilized and foreign capital inflows improved due to global factors and expectation of a stable government. Recent RBI measures are good for the US dollar. Capital flows and global bond yields falling should support the INR well. Impending large rights issues and FDI deals are also supportive of a strong currency. On the flip side, India's current account balance, excluding gold and oil, is still at a 6-year low and is a structural negative. Also, lower imports imply weak domestic demand conditions, which add to the worries of domestic slowdown in auto numbers and recent commentary from HUL. In the near term, strong capital flows should drive a positive balance of payments, implying rupee strength, which should create some headroom for the RBI to cut rates as CPI remains low.
Okay, well, it was a very important week for the rupee. The rupee hit a 7-month high last week at 68.45, but on Friday, there was a tad bit of weakness that the rupee saw. 68.95 is where it closed. V. Prasanna of ICICI Bank says the sell-off in the dollar post the dovish US FOMC outcome turned out to be short-lived as a sharp deceleration in European the PMI is renewed on concerns of global growth slowdown. He says back home, the scale of the RBI intervention to stem further rupee appreciation on the back of capital flows has intensified over the last few trading sessions, and further drain out of dollar liquidity by RBI under the long-term forex swap operation this week is likely to push the dollar higher against the rupee. So maybe more rupee weakness. He expects the dollar INR to trade in a range of 68.70 to 69.40 during this week.
Okay. Well, B. Prasanna says global rates environment has turned further benign after the outcome of the US FOMC and the decline in bond yields across US and Europe. Back home, he says the focus will be on the announcement of the first half borrowing calendar for the next fiscal year. That's on March 26th. He adds that the extent of allocation of supply in first half, the pattern of duration composition and extent of floating rate issuances will have an impact on both the slope and the level of the yield curve. For the week, he expects the 10-year benchmark yield to trade between 7.42 and 7.55. The new benchmark bond yield to trade between 7.26 and 7.4. Basically, today you should expect yields to fall. They've fallen all over the world.
Okay.